Welcome back to The Explainer. Let's jump right in. We're looking at a fascinating synthesis today on the psychology of stock market profits. Studies consistently show that a massive majority of individual investors actually underperform the market. And it's not because of bad math. It's a psychological trap that most people fall into time and time again. So today, we're locking in our final synthesis on how you can stop acting like an emotional participant and start profiting as a conscious, analytical observer. Module 3 is complete, so let's lock in the 4 key lessons you absolutely need to master before stepping out into the real world. We're covering 1. The investor emotion cycle, 2. The VIX fear gauge, 3. Market reversals 4 stages, and 4. Real-world personal indicators. Let's get to it. Section 1. The investor emotion cycle and the trap of predictable patterns. See, emotions in the market flow in a highly predictable cycle. At the start of a bull run, everyone feels optimism and excitement, right? And that leads straight into euphoria. Now, euphoria is the market top. It disguises itself as maximum safety, but it's actually the point of maximum risk. Everyone just assumes stocks only go up. But then a sell-off hits, triggering anxiety and panic. As prices keep dropping, we hit capitulation. This is that brutal moment where the last desperate sellers just throw in the towel at the absolute bottom. It feels terrifying, but guess what? It is actually the moment of maximum opportunity. Eventually, hope and relief slowly creep back in, and the whole shebang repeats. When you look at this, you can probably spot your own past mistakes, can't you? Feeling thrilled right at the dangerous top and absolutely despairing exactly when you should have been buying. So how do we actually combat this? Well, Warren Buffett hit the nail on the head. Be fearful when others are greedy, and be greedy when others are fearful. It's a brilliant rule. The crowd essentially hands you the exact roadmap, and your only job is to have the absolute discipline to walk in the completely opposite direction. It sounds simple, sure, but it is incredibly hard to pull off because going against the herd just feels wrong. But embracing that discomfort, that is exactly what separates the highly successful investors from the average ones. Moving on to Section 2, the VIX fear gauge, measuring the market's panic. We know emotions drive the market, but how do we measure that fear using hard data? Enter the VIX, or the Volatility Index. Think of the VIX as the market's speedometer for fear. It basically measures how much volatility options traders are expecting in the S&P 500 over the next 30 days. It's a really straightforward gauge that shoots up when traders start panicking and buying insurance and drops when they get overly comfortable and complacent. Okay, so here is the crucial number you need to remember, 30. When the VIX crosses above 30, that tells us fear is extremely high. And as we've just learned, high fear equals a historically massive buying opportunity for you. Honestly, you could literally just set a price alert on your phone for this number so you know exactly when to start checking your watch list and getting your capital ready to deploy. And history absolutely proves the power of this signal. Just look at these massive events. During the 2008 financial crisis, the VIX peaked at an unbelievable 80. And what happened? The S&P 500 returned plus 60% over the next 12 months. In the 2020 COVID crash, the VIX hit 65, and that was followed by a 70% return. Even with the 2022 Fed rate hikes, a VIX peak of 38 preceded a 26% return. Every single time fear spiked to these historic levels, life-changing returns followed. Spikes aren't a signal to run away, guys. They are a giant flashing invitation to buy. Section 3. Market reversals 4 stages. The roadmap of a crash. Let's zoom out a bit. Every single market reversal follows these exact 4 stages. Step 1 is euphoria at the top. The market's been running hot for years, the media is incredibly positive, and valuations are just totally stretched to the max. Then, step 2 is the snowball effect on the way down. A piece of bad news triggers a drop, panic selling kicks in, leveraged accounts get margin called, and that downward momentum just builds and builds. Step 3 is the bottom. This is where capitulation happens on massive trading volume. And crucially, this is where we usually see government intervention, things like interest rate cuts or emergency stimulus packages that step in to stabilize the system. Finally, step 4 is the recovery, the light at the end of the tunnel. Understanding this entire sequence totally removes the surprise. You know exactly what's happening, so instead of panicking, you can pull out your shopping list. And our final pillar, Section 4, Real-World Personal Indicators, the street-level view. Sometimes your own eyes are your best tool. Look around you. On one side, we have signs of euphoria. Restaurants are packed, your taxi driver or your dentist is suddenly giving you hot stock tips, and everyone feels like a financial genius. When you see this, pump the brakes and be very cautious. On the flip side, we have signs of depression. The lipstick effect, where people start buying small, affordable luxuries instead of big-ticket items. You see doom and gloom headlines every single day, and there is complete silence from your friends about their portfolios. When you see these signs of despair out in the real world, it's time to start buying. The pendulum always swings to extremes. Module 3 is complete, and our key lessons are locked in. Let's recap. 1. The investor emotion cycle is predictable and repeating, so learn to identify each stage. 2. The VIX is your fear gauge. Above 30 means fear is high, which means the buying opportunity is historically strong. 3. Every market reversal follows 4 stages: euphoria at the top, the snowball effect on the way down, the bottom with government intervention and recovery. And 4, real-world signals from your daily life are some of the most reliable indicators you have available. In our next explainer, we're zooming out to the biggest picture of all, the global macroeconomy. We'll be breaking down how interest rates, government policy, and global events actually affect your portfolio. Plus, we'll cover how to build true diversification across assets, countries, and sectors. You definitely don't want to miss it. So, what real-world signs are you seeing in your daily life right now? Tell me in the comments, are you seeing fear or greed out there? Your personal observations might actually be more valuable than any chart. Also, check the pinned comment. What emotion stage do you think the market is in right now based on what you see around you? Euphoria, anxiety, panic, despondency, hope, or relief? Drop your reading below. I really want to see what you're observing in your specific city and country. The crowd's collective reading is often the most accurate signal we have. Now, if this explainer opened your eyes to how much psychology really affects your investing, please hit that like button, subscribe so you don't miss our next explainer, and click the card on screen to go straight to our next deep dive: how to diversify your portfolio like a pro. I'll see you there.